Good morning and welcome to another 5 with Fitz. I'm Keith Fitz-Gerald. Thank you so much for joining me as always. You know, headlines say that the markets are down after an unexpected decline in private payrolls data. Sorta on the mark. Take a look at the US 10-year Treasury yield. That's your tell, meaning a signal that reveals what's really happening behind the headlines. And it's a term that you borrow from poker, as in what you're doing is going to give your hand away. Anyway, the U.S. Treasury yield is still higher at 4.283% as I record this. Now, here's why this is important. Treasury yields control the cost of money, and when that rises, stocks tend to fall because heavily leveraged traders don't want to pay the VIG, meaning what it costs to borrow all the piles of money that they use to boost their returns. If anything, the weak ADP jobs report is just a convenient explanation. Now, that begs the question. Why won't you hear what I'm telling you anywhere else? Well, that too has a simple explanation. My guess is that 99% of all news personalities have never run real money, so they have no idea how traders really do their jobs. And not for nothing, bluntly, it takes too much time to explain what I've just shared with you in the 10 seconds per headlines that seems to pass for deep coverage these days. Anywho, don't let it faze you. Rates are for traders, profits are for investors. My guess is that the NASDAQ goes positive by the time you and I are viewing this or reading this or listening to this or even reading the written version of this. And boy, is that a mouthful. Perhaps even the S&P 500 too. And that depends whether or not traders can shed enough risk and leverage that they're comfortable buying back in again. Now, how do I know this? Because I'd be doing the same thing back in the day. Anyway, here's my playbook. Number one, is it time to buy Meta? Now, I joined my friend and colleague, the Venerable Scott Sheldy, aka the Cow Guy, on RFD TV yesterday, and we spoke about Meta and the investment potential of AI, which I maintain is still one of the single largest investable themes in recorded human history. Now, I think Meta, there's a good chance that Meta goes to $1,000 a share. Will I buy it directly? Yeah, that remains to be seen, because I still don't trust Zuck, but that's just me. But I love the fact that plenty of other people do and celebrate everyone who's on board. Meanwhile, I'm content with a fund that owns shares via the Fundfolio, a retirement-friendly, simple concept that I created for the OBA family. Now, number two, AstraZeneca just put a nail in the coffin that used to be known as the London Stock Exchange. You've heard me say it dozens of times. Money is like water in that it will always flow to where it's treated best. Well, not for nothing, but it seems like UK politicians are getting another lesson the hard way today. Now, I'm not surprised, and you shouldn't be either. AstraZeneca is Britain's most valuable company on the FTSE 100, and it's reportedly considering moving its stock listing from London to the US because the CEO, Pascal Soriot, is apparently fed up with the UK's regulatory hurdles around new drug approvals and pricing systems. Familiar, huh? Anyway, as an aside, were it not for geopolitics at the moment, I think there's a very good chance that AstraZeneca would have otherwise gone to Shanghai. But that's a different story for another time. This isn't just another company that's on that side of the pond. AstraZeneca is the single largest, most valuable company listed on the London Exchange with a market cap of 160 billion pounds sterling. Now, if it leaves, you can bet dimes to dollars, or in this case, pounds sterling, that others will follow. Companies listed in London often trade at 30% lower valuations than their U.S. counterparts. If you factor in tighter regulations, fewer incentives for growth, and a smaller investor pool, the choice becomes obvious. Why would you stay there if it punishes your success? Many won't. So here's a trade idea. Hang with me on this. Short or avoid UK stocks if AstraZeneca actually does hit the eject handle. There are a few options and a few ways to do this listed on the London Exchange, which is a lesson in irony here, considering what we're talking about. The X-Trackers, FST, FTSE, FTSE, 100 short daily swaps. There's the Super Short Strategy Daily, which is a 2x leverage. There's also a FTSE 3x daily short ETF. Closer to home, there is no direct inverse to the FTSE 100, but there is a fund that could help you backdoor the trade via exposure to Europe. And that's the ProShares Ultra Short FTSE Europe. Symbol is EPV. Now, this ETF aims to deliver twice the inverse return of the FTSE Developed Europe All Cap Index, meaning it'll go up when the All Europe Index goes down. Now, like two of the other three funds I've just mentioned, it is leveraged though, which means important point. It is totally inappropriate for anything other than extremely short-term daily use because it could deviate widely from intended performance over long periods of time. Now, I know that's a mouthful, but it's very, very important you understand that. Do not make the mistake of holding something like that long-term. It is short-term, tactical, daily only. Now, number 3 today. Did Jamie D just get his ways? JP Morgan CEO Jamie Dimon sued regulators in October 2024, and we talked about that because he felt that the powers that be were out of line with what he called overlapping, ill-conceived rules on capital requirements, card payments, and open banking, among other things. It's time to fight back, he said bluntly at the time. Well, what do you know? News out this morning, JP Morgan Chase just got a big regulatory win. The Federal Reserve has, reduced its stress capital buffer, the SCB, from 3.3% to 2.5%, which lowered the bank's CET1 capital ratio to 11.5% from 12.3%. Now, hang with me. I know this is very technical. This frees up roughly $18 billion in excess capital, which gives JP Morgan more firepower for shareholder returns. And not surprisingly, JP Morgan wasted no time announcing a $50 billion buyback, the largest by any U.S. bank, and a dividend hike to $150 per share, which is a 7% increase over last quarter. JP Morgan, a company we talk about all the time, is a masterclass in capital management and risk assessment. It is also, very bluntly, an excellent case in why I prioritize strong executive leadership when it comes to selecting the stocks I want to own and encourage you to think about. Regional banks, which people constantly tell me are worth a look, pale in comparison when you're playing in the big leagues. So, buy the best and ignore the rest, quite literally. Hoo-yah! By the way, do you know what to look for in a CEO? If so, groovy. Continue to do so because it's going to make a huge difference to your profitability over time. If not, and you'd like some help, I'll be here. Number 4, Figma's next hat trick. Back in September 2022, I told you about Adobe's $20 billion bid to buy Figma, the collaborative design tool that runs circles around Adobe's own products. Now, regulators, as I thought might be the case, didn't see the mojo here. Figma and Adobe scrapped their acquisition in 2023 after UK regulators blocked the deal on antitrust grounds. Adobe had to pay Figma a $1 billion breakup fee. And now, here's the important part, Figma is filing to go public on its own. The company plans to list under the ticker FIG, F-I-G, on the New York Stock Exchange after a $12.5 billion valuation in last year's tender offer. Now, CEO Dylan Field says that investors should expect Figma, and this is the interesting part, to take big swings as a public company, including its own acquisitions. This is a fascinating plot twist. The thesis remains that big tech buys growth, but when regulators block the buyouts, strong startups like Figma end up IPOing anyway, just with an extra billion in their pocket and an even stronger balance sheet. Either way, my POV is that owning the big dogs still puts you in front of the trend, which is why in situations like this one, it's also worth keeping an eye on companies like Figma that survived the acquisition gauntlet to emerge stronger and ready to swing for the fences. All right, number 5. You're not going to believe this one, and neither am I, but is it time to go bottom fishing with Intel? Newly CEO Lip-Bu Tan has concluded that the manufacturing path chosen by former CEO Pat Gelsinger was a bust. Like, that's news. But anyway, he's shifting gears according to reports on CNBC, citing the usual anonymous sources. But Lip-Bu Tan wants to convince other companies to use Intel facilities to make their chips. Now, is this a Hail Mary or a stroke of genius? Honestly, I could make the case for either. But Intel turned a once storied legend into a company that badly lost its way, having missed both AI and mobile. The process that Bhutan is talking about ditching is 18A, which is apparently roughly equivalent to TSMC's N3 manufacturing process, if I've got my facts straight. I mean, this stuff is very technical, very hard to deal with. And the one he wants to go to is called 14A, which would give it a better shot, but this is the part where I get intrigued. Require customers to place their bets and wait. Now, Wall Street probably won't like that. So I view this much as famed boxer Muhammad Ali viewed the rope-a-dope tactic he used so frequently and successfully. Lip-Bu is planning a shift, but existing customers will draw on 18A while it exists. Intel, if it shifted, would have to take a multi-billion-dollar write-off to move away from 18A, and Wall Street would probably punish the stock terribly. If, however, and this is the bet here, Lip-Bu successfully convinces major customers like Amazon and Microsoft to go to 14A, along with Apple and Nvidia, that I've got to believe are the real targets here, there could be new contracts, new revenue, and new profits. Now, here's the trade idea into my thinking, why this is a rope-a-dope. Any series of speculative lowball orders at progressively lower levels could work nicely. So, for example, $20, $50, even $10. Makes you think, huh? Today's bottom line is really simple and really relevant. Contrary to what many think, there's no shortage of profit potential right now. Just a shortage of people thinking big enough. So grab your share or somebody else will. As always, let's make it a great day. You got this, I promise. Thanks as always for watching. See you tomorrow.